Hi and welcome to Swissquote's Daily Market Talk. It's Monday, October 6th. Japanese stocks are rallying this Monday while Japanese bonds and the Japanese yen are tanking following the appointment of the new LDP leader there, who is about to become Japan's new PM and who is in favor of easy fiscal and monetary policies. In the US government remains shut and economic data releases are delayed. In France and in the United Kingdom, political shenanigans continue to dominate the headlines. As such, capital flows out of the traditional currencies and into gold and Bitcoin. Oil is also better bid this morning after the OPEC's weekend announcement, and the earnings season is just knocking on the door. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the week kicked off on a positive note in Japan. After the ruling LDP there chose Sanae Takaichi as its next leader, she is now set to become the country's next prime minister, and she is known for her taste for easy fiscal and monetary policies. So easy fiscal policy and more government spending are obviously not great news for the Japanese bonds, as they are already rising, mind you, quite steadily since 2020. In this context, the Japanese 20-year yield was nearing 0% 5 years ago and is now up to nearly 2.70%. It actually jumped 6 basis points this morning. And the 30-year JGB yield jumped 12 basis points to the August high levels and multi-decade high levels as well. On the currency front, while the Japanese yen slipped on expectation of softer Bank of Japan policy path and perhaps softer rate hikes as well in the future, and the dollar yen soared past the 150 psychological level. And for equities, while the Nikkei jumped more than 4% to a fresh all-time high level this morning on optimism that softer fiscal and monetary policies in Japan, combined with a softer yen, are all very much supportive of the Japanese equity market. So here is the picture. Inside equities, the defense stocks will especially enjoyed the news, as the new government spending could well increase for the military spending as well. And that is obviously very, very much positive for the Japanese defense stocks in this context. Japan Steel Works, for example, soared nearly 14% today. So voila, it was a great start to the week for Japanese equities and much less for the Japanese bonds and the Japanese yen. But note that the rising Japanese yields do threaten risk appetite in other pockets of the global financial markets by making the risk premium of other assets on the Japanese JGBs narrower. But happily, I say happily, strong dovish Fed expectations these days and the global AI rally will likely keep the global risk appetite in check in the US and elsewhere the United States, while European equities will also probably continue to benefit from this positive echoes of the global financial markets and the global AI rally, and also the softer BOJ bets now joining the dovish Fed expectations. So all is good for the risk appetite. The S&P 500 Nasdaq futures are in the green at the time I'm talking here this morning. We are just before the European opening bell, with Nasdaq seeing a better appetite actually, certainly thanks to Hon Hai, which is one of Nvidia's major server production partner, announcing an 11% growth in its latest quarterly sales. So that's another signal that the AI demand remains quite strong. And other than that, over the weekend, OPEC announced it will raise its oil output by 137,000 barrels per day in November, following a similar increase in October. But since the move, the news had already been mostly priced in last week after a 7% sell-off in US crude, remember. Oil prices rebounded this Monday morning, nearly 2% in Asia, flirting with the $62 per barrel psychological level. But note that despite the rebound this morning, the bounce comes after prices broke below the $62 per barrel level, which was the summer sideways trading range bottom, on expectation of this very production hike from OPEC. So, broadly speaking, the broader outlook for oil is now more tilted toward the downside than it was last week, with a greater likelihood right now of prices slipping below the $60 per barrel psychological level than climbing back above the $65 per barrel level. Now that we talk about what has been announced, now let's talk about what has not been announced over the past few days. So US official jobs data that was due Friday was not released last Friday as the US government remained shut. And the economic data that is scheduled for this week will also likely not be released if the US government remains shut. And the likelihood that is given to that scenario of US government being shut throughout this week is around 60 to 80%. So in the FX, the US dollar is better bid this morning in Asia, and that's broadly thanks to a sharp sell-off that we saw in the Japanese yen following the LDP announcement. But in fine, if you look broader in the markets, none of the traditional currencies, the major currencies, looks appetizing at this point. Because obviously the US dollar is subject to headwinds from the trade war, from the political and geopolitical tensions and uncertainties, and the rising debt worries. Sterling is hard to love as well, with the political and budget uncertainties into this autumn budget in the United Kingdom. Then the Japanese yen, once a safe haven, is also dealing with its own debt and political demons. And the euro is probably the best among the cited, among sterling, US dollar and Japanese yen, but the French political shenanigans remain very much on the headlines, with the new French government that is just being put in place, mind you, right now, is already facing an increasing risk of no confidence, it is said. So among traditional currencies, the Swiss franc is probably one safe haven that still stands, but here as well, the Swiss National Bank is showing its teeth to the Swiss franc bulls by suggesting that they will dump their Swiss francs to the market to counter a significant appreciation of the Swiss franc. So be careful, they say. So, in this context, assess that how no government ties, like gold and Bitcoin, for example, see increased inflows into them. Gold, in this context, just rallied to a fresh all-time high level this morning in Asia. It traded at $39.45 per ounce level, and it will more likely than not hit the $4,000 per ounce psychological level in the coming days or weeks, and it's seen moving toward the $5,000 per ounce level by strategy in big banks, including Goldman Sachs. Silver hit $48.50 per ounce level this morning, with bulls eyeing an easy extension of gains above the $50 per ounce psychological mark, and Bitcoin briefly traded above the $125,000 level over the weekend. So these assets will likely continue their journey higher, if nothing, thanks to a globally cheaper and unload US dollar. Now, zooming out from currencies and other assets and coming back to economic data announcements of the week ahead, there is not much on this week's calendar. China will be closed for Golden Week holiday until Thursday. The European Central Bank's Christine Lagarde and Bank of England's Andrew Bailey will be speaking today. The Reserve Bank of New Zealand will likely announce a 25 basis point rate cut when it meets on Wednesday, and the FOMC minutes will be released on Wednesday this week as well, a few hours after the RBNZ decision on Wednesday. And there is a very, very slim chance the official US jobs data will still be released this Friday, but I wouldn't bet my shirt on it because I'm not really sure that the US government will be reopened by then. So in the absence of economic data, US investors will focus on Wednesday's FOMC minutes, looking for any hint of further dovishness there, and on the upcoming earnings season, because yes, it is almost the earnings season and expectations are actually quite sweet. I'm saying quite sweet because they are sufficiently optimistic into the earnings announcement, but they are not actually unbeatable. So the S&P 500 is expected to print a 6.3% revenue growth and a nearly 8% profit growth in the third quarter of this year versus, well, 12% in the latest quarter. So it is okay. While technology stocks there are expected to report a 21% profit surge on AI demand, then utilities and financials are expected to print 17.5% and 11% rise respectively on their end, while energy and consumer staples are seen printing 3% decline in their own profits due to the global trade war and also the falling energy prices. So voila. And that is the picture. The first earnings will be landing this week on Thursday with Delta, Levi's, and PepsiCo's third quarter results, and BlackRock will be reporting on Friday this week. So we will talk about all that throughout this week, but this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.